Hey guys, what is going on? Welcome back to my Robinhood portfolio. Hope everybody had a fantastic day of trading today. Today I'd like to talk about PE ratio. I brought this up in my last series of videos talking about different stocks to invest in. I've been referencing this quite extensively, and in response, a lot of new viewers on the channel have been wondering exactly what it is and why is it so important. So I thought I'd just quickly go through and remind you of guys exactly what a PE ratio is. I had put out a few videos a few months ago talking about the PE ratio, but I thought I would do an update video here again because there's a lot of new viewers on the channel and to refresh you guys on exactly why I reference this so extensively in my videos. So PE ratio is nothing more than price to earnings. As the name suggests, it's a ratio between price and earnings. So for example, Boeing here, BA, the price is $201.52, and if we take a look at the earnings per share here, EPS, you can see over the last 4 quarters it has been about 20 cents or so, $3.60, $2.15, and then right above $2. So if we add that up, that's about $8 over the last 4 quarters, so about $8 per year. So to calculate the PE ratio, we simply take the price divided by the earnings over the last year. So we essentially take $201.52 divided about 8 or so. Again, this isn't exact, but we don't need to be exact for this particular example. If you do that, take 201.52 divided by about 8, again, the earnings over the last 4 quarters, it comes out to about 25.19. If we take a look at the PE ratio here, we can see it's 24.734. So essentially, that's how it's calculated. And again, if I could take a look at these earnings in a little bit more detail, I could get that exact number, and the PE ratio should come out to 24.734. And we essentially do that calculation to see how much an investor is willing to pay per dollar of earnings. So essentially what the PE ratio is saying is that every investor who invests in Boeing is willing to pay $24.73 for every $1 of earnings the company generates. Other companies have different numbers for this. For example, Lockheed Martin here, for every dollar of earnings, an investor is willing to pay $21.56. For GE, a little bit lower. No, actually, it's quite high as well. For every $1 of earnings, for GE, an investor is willing to pay $25.21. So it's really judging how pricey the stock is with regards to the price of the stock. There's a lot of different ways in which a stock is expensive or not based off the dollar amount alone, but also the PE ratio. So as you can imagine, a PE ratio that is higher, it's going to be more expensive to own that stock, regardless of what the underlying price of the stock is. So 133.62 really doesn't dictate if the stock is pricey or not. It's really dictated by the PE ratio. So if this PE ratio is very high for any particular market segment, you may not want to invest in that stock because the stock may be overvalued. And another key point behind the PE ratio as well, which I don't think a lot of folks take into consideration when talking about PE ratios, is that it differs between market segments. So a good PE ratio for industrial stock is not a good PE ratio for a healthcare stock or a consumer discretionary stock or consumer staple stock, financials, telecoms. They're all different. So you can't really compare a PE ratio between the telecoms, between information technology stock, financial stock, so on and so forth. You simply can't do that. But you can compare PE ratios in a particular class of stocks. So for example, my pharmaceutical stocks here, you can compare very roughly the PE ratio between all these pharmaceutical stocks. ABV here, 18.77, Eli Lilly and Company, 40.50. So in terms of earnings, Eli Lilly and Company is a much more expensive stock than AbbVie Incorporated, if that makes sense. Not because of the share price here, but because of the PE ratio. That's really what's dictating if a stock is of value or is not of value. Pfizer, for example, its PE ratio is 28.38. So this is a much cheaper stock, again, regardless of what the stock is selling for, but per dollar of earnings, each investor is willing to pay a certain amount, and the more they're willing to pay, the more expensive the stock is. And as I talked about in my last few videos, a lot of growth stocks have very high PE ratios because the investor is not paying for the earnings that it currently has, but earnings in the future. So, for example, if investors thought Pfizer was going to quadruple in size, they would not be paying for earnings now, they'd be paying for earnings in the future. So if Pfizer, for example, had a PE ratio of 28.38 now, but the company was going to quadruple in size, an investor may want to pay more for that So the PE ratio may be 100, which for a growth company is okay because you're essentially buying future earnings. However, if the PE ratio is very high and there's really no growth in the company is probably overpriced. So I hope that makes sense. PE ratio, very easy to calculate. You simply take the share price divided by the earnings over the last 4 quarters or earnings over the last year. That gives you the PE ratio, and then you can compare that against other companies in a particular market segment to see if the company is value, undervalued, overvalued, overbought, really telling you how much an investor is willing to pay for every dollar of earnings earned by the company. So again, you can't compare really between market segments, but you can compare between companies in a particular market industry. And a good example here, Portola Pharmaceuticals, a very small biotech company in its infancy. It has negative earnings, so it can't have a PE ratio. The PE ratio would essentially be infinity. If you were to take that negative earnings in the earnings part and put, a very, very low number, 0.00001, or something equally as small, any number above that is essentially going to have that PE ratio approaching infinity because you're basically paying for negative earnings. So the PE ratio is infinity. Hope that makes sense. So that's why we take a look at the PE ratio. It's really telling us if a stock is overvalued or is of value. Again, comparing it between other companies in its particular market segment. So I can compare the PE ratio of all my pharmaceutical stocks here, for example. When I get into my industrials here, starting with Boeing, then I can compare all of my industrials. Again, some of these are a little bit different. For example, Boeing, Lockheed Martin are in aerospace. GE, 3M are conglomerates, so you could really compare fairly easy between 3M and GE here. A little bit more difficult between Lockheed Martin and GM because while they're in the same market industry, they're still in the industrials. One's in the aerospace industry, the other is a conglomerate company. So it's a way of comparing companies, and it's really useful if, for example, one PE ratio, like for example, if 3M was 100 and GE was 10, you could maybe say GE is very undervalued, 3M is overvalued, if the average was, for example, 50 in this particular market industry. So it's really a way of judging value of a company. It's not perfect. There's a whole number of different metrics that are used, but PE ratio is one of the more popular, and that's why it's listed here in Robinhood, along with dividend yield and market cap. Very useful numbers and very useful for comparing, again, companies within its market sector. So I hope that makes sense. I hope I didn't confuse anybody with that. If you guys have any questions about that, let me know in the comment threads down below. But a fairly easy number to calculate and very, very useful when comparing a company against other companies in its particular market class, as well as comparing a company to the overall S&P 500 PE ratio to kind of judge if a company may be undervalued or overvalued moving into the future. So yeah, just wanted to quickly talk about PE ratio. I know I've referenced that quite a few times in my last few videos. A few of you guys did not exactly know why I was referencing or what the significance behind a PE ratio was. So I thought I'd just kind of go through, define it, use an example as Boeing, how to calculate it, and again, how to use it in a useful fashion. A lot of people are simply referencing a PE ratio without really taking into consideration the market segment the particular company is in. You can't really do that. You can't say, for example, a great PE ratio for Boeing here and compare it, for example, against McDonald's here. It simply doesn't work that way. I've seen a lot of people do this in videos. It's worthless doing that. You can't do that. You can't compare a PE ratio in one market industry against another market industry, only within the market industry. So you can compare a McDonald's PE ratio with Yum Brands China, for example, but you can't compare McDonald's against a Boeing, a Ford, a pharmaceutical company like Pfizer. It just doesn't work that way. So I hope that cleared up some confusion. Again, if you guys have any questions about that, let me know in the comment threads down below. And kind of with that, I'll end the video. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. Again, I appreciate your guys' support. The channel would not be where it is without you guys. If you guys have any great video ideas, let me know as well. Always looking for new things to read up on. And again, if you guys have any questions about PE ratios, anything at all, anything that I reference in my other videos, let me know, and I'll do a video for you. So kind of with that, I'll end the video, and we'll see you guys next time.